reporting and annual reporting in U.S. GAAP, okay, of a foreign traded stock, okay? So, we'll go into more into that, and then just trading dynamics, I'll finish with this. There's a lot of different, so there's a lot of different sort of concepts here. There are circuit breakers that exist, that there's large movements in the stock, the market's shut down. Let's take a timeout, let everybody sort of gather their thoughts, okay? There are indices. We've talked about some of these indices that try to give us ideas or trends as to you know, what's going on. So we talk about the Dow Jones Industrial Average. That's 30 leading, theoretically industrial, but they're mixed large stocks.
Have they changed?
Yeah, they change them all the time. They change them all the time. Now they adjust the index for them, okay? The S&P 500 is what people view as the market in this country, but there's broader indices. You know, there's a Wilshire 5000 and 3000 and 2000. There's a Russell 2000, you know.
Which do you look at? All of them?
I look at, there's a NASDAQ 100. I use this personally as my benchmark. And I've got this sort of theory on a normal day. Don't hold this to be true, because it's not true. But sort of mathematically, if this is up 10, this is probably up 20. I'm sorry, this is up 20 and this is up 100. That's not really the relationship, but this is roughly at 2,000 and this is at 19,000. So you can see how I can draw my sort of mathematical, you know, okay? And this is like at 5,000. Okay, so you can see why you've got the San Miguel theory, but it's not really, some days they don't move together either, okay? So, just forget that. There's no, that's one of those sort of like psychological things that I do. I use this one. For me, this is the measure that I use, okay? Trades. And for countries, there's, you know, at the FT 100, the FTSE 100, the IBEX 35, you know, the CAPM, you know, the Nikkei, whatever. So for every country, you get these different, which hopefully give you a sense of where values are going. Okay.
The JSE, Jamaica Stock Exchange.
There we go. Trades. So just a couple of trades. I mean, you know, you've got simple buy and sell orders, right? So, you know, buy so many. So you can do these at market. Okay? So you tell the broker, just sell it at whatever the market gets, and then it puts it out there, right? In theory, in an auction environment, I'm selling 1,000 shares, and all these people bid. In reality, it's all sort of, you know, order driven now, and the value of a good broker is that they get you, when you do market orders, they give you something very close to that medium between the bid and the ask, right? I haven't done it this time, but we had an article on the implications of bid-ask spread as it related to REITs, okay? How broad, because the more broadly traded the stock is, the tighter the bid-ask spread, okay? But you don't have to do a market order. You could do, for instance, a stop or a limit, okay? So a stop order says what, for example, like a stop loss order says what?
Well, if my stop goes below a certain
right, so it's a pre-order that you make out there that says, okay, my stock's trading at 30, but you want to protect it, that it doesn't go below 25. So you have a standing order that says anytime it goes to 25, sell it.
That was that was one of these articles that you gave us on these assessments, was about these automated programs that just do the automatic.
Right. So what happens? All these things go to specialists. Okay.
And it just kind of just snowballs, right? Because
well, right. But there's another sort of implication to that is these specialists also know everything that's out there, so they kind of know trigger points, and they can build their programs around where all these things are at, because they know that they got a bunch of stop orders here at this value. That's a critical support level. That all of a sudden, all these sell orders triggers, all these values are going to go up.
Or you should have drop orders. If your grade goes below a certain
Then you drop.
Didn't that happen in the flash crash? It triggered all
Yeah,
these
it was
stop words,
something
everyone
like that.
lost
I
all
don't know
their
at the end if
positions.
they yeah, I mean, I think they discovered it. I didn't read what it was that, caused it. The problem with the stop loss, there's one problem with the stop loss is that it doesn't cover huge drops, right? So, and what happens is, when the companies report, typically after or before the bell.
before.
Well, before or after, companies never report, rarely report any news during trading. So what happens is all press releases on like earnings and all that stuff is after the bell or before the bell. So if all of a sudden somebody reports bad earnings, the stock's not going to go from 25.25 to 25. It might go all the way down to 15. And so your stock comes in, you're the first trade of the day, you haven't even woken up yet, and you blew your stop, but it didn't stop at 25, you got stopped at 15. I had a situation once, and it wasn't a flash crash thing, but there was, and I forget the numbers, but I had a stock that was trading at 20, let's say, and I had a stop loss at 15, and there was like a blip at one point in the middle of the day, and there was one transaction at like 14.50. It was a very thinly traded stock, and it happened to be my 1,000 shares or whatever, okay? And all of a sudden, boom, it went back up to 20. So I called Schwab, and I'm like, dude, I got screwed, I mean, what is this? Like, I'm the only transaction there. And they said, well, there was only one bid at that point at 14.50, so that set the price. It triggered your thing, and then immediately after that, we got a bunch more orders at 20, so tough luck.
And they know you have that stop loss there.
Well, that goes to a specialist. That goes to a specialist, but somebody knew it.
Yeah.
I lost $500. I got took, okay? I got took. But the problem is stops don't just happen there, boom, okay? But they're good. They're good to put in place, okay, to protect portfolio values. Limit is when you say I don't want to buy more or pay more than X, right? So you say I want to buy, but I don't want to buy more than X. Okay, and you can put a stop limit where you say, okay, when it hits the limit, when it hits 25, then put the stop loss in at whatever, 23 or whatever. So there's combinations of different trading things. So what I leave you with is going back to market efficiency, relax. When we talk about market efficiency, if we have a weak form, it basically says that technical analysis should not be able to help you out, okay? Because there isn't enough information out there to really have a sort of holistic or systematic movement in stock. If you've got semi-strong, okay, semi-strong, there's widely known information. I'm going to believe we're in a semi-strong environment. I think there's arbitrage opportunity. I think there's mispricing there. I can do fundamental analysis and find mispriced stocks, stocks trading below book, high dividend payers, where the market's got it wrong, and I can make money. In a totally strong and a totally efficient market, there are no arbitrage opportunities because all the information is widely known and distributed and embedded in prices. And so if we truly are in a strong form, in a strongly efficient market, only passive investment strategies would work, index investing. Because there's no arbitrage opportunities, you're only going to get what the market gets, okay? So, the argument would be if you believe we're in a strong market, then, you just do index investing. If you think you're in a weak, then I'd probably go somewhere else because that's like India and places like that, or China, where you don't really know what you're reading. If you're in a semi-strong, which I think is what most of the developed world is like, theoretically you've got some fundamental, hopefully actively managed stock investing can be successful. Okay? So that's the presentation on the equity markets and trading and all that. I've skipped over some things, but I hope you found this interesting
Yeah.
and valuable. Okay, now, things work the way they work. We have two presentations today, but we're only gonna have one because the way, what?
So somebody got lucky.
Well, all right, if you want, we can stay.
No. I'm good.
It's not that.
You should make the paper, rock, scissors to see who goes first.
No, you're gonna go. And so what happens is I wanna in advance, I want to congratulate Danilo for the following, because candidly, for the first time since I've been teaching in this program, I've found somebody who has become so obsessive and compulsive in their research of a particular topic. They've reminded me of me as a student. And his paper was at 3,500 words, and he was like, I still have stuff to write. Do I keep writing? I'm like, no, you've written enough. And last night, when I was about to leave the office, he says, could you please review page 31 of my PowerPoint? And I said, have you didn't attach anything? And I was like, I know you're kidding. You can't have 31 pages in a PowerPoint. And he didn't, he had 35. But, so he's going to work on making sure that he can present that in 20 minutes. But the reality is where he's taking his presentation really corresponds with our next lecture. And so just timing wise, it's going to work out better that you're going to present next week, because it really does go much better with his presentation on rating agencies really belongs next week.
Could he present before the class? I mean, before the lecture?
Typically, yes. That's typically that's the way I do it, yes. I just didn't want to go before today because we had to get through this material today, okay? And I'm afraid.
That would be good then, before the lecture. Then we have meat on the bone to proceed.
But I do want to compliment, and I really want to, say that I appreciate somebody taking a topic that perhaps doesn't have a lot more than just other intellectual curiosity value to it. I think there's some pragmatic value to it, but I'm sure he went beyond that. It was like, dude, I'm going to attack this shit, and I'm going to learn, I'm going to be an expert on this, and so that was good. So I wanted to, and then before I get to Koesi, I was generally very positively surprised by the midterms. Okay, and I would say I had a couple garbage ones. Okay. But for the most part, I think I had like 4 grades over 95, which I've never had anything like that. So maybe you were smart enough to figure out the answers I was looking for, but the answers were all in your hands. They were in the, they were in the book, they were in the notes I gave, they were in the presentations. Not to point out, but just because you're new in the program, try to focus your answers more on the material. When I asked the questions, I was looking more for the answers that we had presented in class, as opposed to your own original thinking, which may have value, okay, may have value, but, if you stay closer to where the professor's thinking, he's probably going to think more highly of your original thinking, okay? So, but no, I was very pleased in general, and in general, most people are doing very well in this class, and I'm very happy to see that. So,
do you actually review the exams? I mean, like you...
He did?
Yeah, I read them, and I read them, and
You make
and I
notes?
I write on them. I used to actually print them out and bleed them and all that stuff, but that's like when I used to have like 5 students.
How do our results compare to previous semesters?
Higher, much higher. Generally much
them
higher.
back, or do we get to see them, or?
You can, if you have a question on the grade, I've got it on my zip drive. I'm happy to sit down with you and tell you where you missed. I mean, we went over the answers the other day. I think where, and I'm not trying to personalize it with you. I think, and I'll be candid with you in your case, I don't think you were off. I think you lacked depth that a lot of other students had. So, there's a critical comment on your particular, there's enough here that I remember. You had Investopedia references as well. I'm not trying to pick on you. I'm just, just being, but not as much wrong as, I got from Ben 1 whole page on every question, for example, single spaced, You know, he dug in, you know. I thought Kwesi wasn't extensive, but to the point, you know. Marianela went, you know, to the point. Luis had good answers, so Danilo had a very extensive submission, you know, needless to say. So, no, but so with you, what I would just say is not so much wrong as much as I would have liked to have seen a little bit more sort of digging. Okay, a little bit more sort of depth, you know. Okay, now with that, so Kwesi's got a presentation for us today, which, if you want to start, is it up? Well, he's going up. So, you know, we haven't done, one of the presentations that we do sometimes in this class deals with, let me just get my zip drive out. Deals with one of the basic tenets of current day finance or modern day finance, which is modern portfolio theory. And while it really takes a different view, you know, modern portfolio theory talks about reducing risk. So, given a certain expected return, how do we lower risk by diversifying? Or given a certain level of risk, how do we maximize return by diversifying? The real ultimate question is, or the real ultimate point is that diversification should be a tool that we should use because at the end of the day, it should enhance return and lower risk. That's what modern portfolio theory is going to tell us. As it relates to REITs, as it relates to the public quadrant, Luis, of...
Yeah, I wasn't checking my grade from email.
Okay?
Come on, man.
Come on, bro. I mean, listen, people who live in glass houses should not be casting stones, Ben. Ben?
Speaking from experience.
No, yeah. Multiple times today, may I add. Excuse me. Okay, so...
People working,
but,
so it's...
okay, but the point, but the point is diversification should be a tool that we should use that hopefully helps us enhance value and minimize
Provide a
risk.
safety net.
At the same time, when we extend that thought a little bit and we look at the public quadrant, so in real estate, research is widely available with public equities, with the public equity quadrant of the capital, you know, the box, right? And that's because they provide more information. So the article that Kwesi took really ultimately goes back to, is diversification really a valuable tool as it relates to expected returns on that public quadrant? And what's happened over time is that we've kind of developed between what are, and I'll stop here, diversified REITs that invest across the spectrum, or specialized REITs which focus on a particular asset class. And so, because there's information available out there, Kwesi's taking a look at the article he's going to present to us. Does in fact diversification trump specialization? And with that, I'll turn it over to, is there a volume? There is, but I have no idea where it is. Because you want to show a video?
Sort of, yeah.
Sort of? Okay, well the first thing is we need to turn this on. You could at least, I'm sure, work with that one. Okay, that looks like that might be up. And then we'll see how... Oh, whoa, I don't want to... Okay, you've got a laptop on, right? Do you want the laptop?
No, I want the computer.
Okay, so... No, so we just want the PC for right now. Okay, so right now...
The laptop is just my notes.
Oh, okay. It should be...
Ardisha dropped the class.
I'm sorry? Ardisha? I don't know that she has, but she's not around, and apparently she told someone that, yeah, she was going to drop from the program or something, but I haven't heard
The
anything.
entire program?
Yeah, but I heard that secondhand, so I don't know.
She's coming all the way from Tampa.
Well, we've had, listen, I've had a student,
From
so,
Atlanta.
listen, I had a guy who commuted from Jamaica, older than you,
Commuting from Jamaica?
From Jamaica.
On the weekends?
Wow.
well, he had a
Yes.
place up here.
Crazy.
I think he was a widow. I never got to that, but he had a place up here, and he would come, and he'd come a couple days before, stay a couple days after. He wanted to buy some multifamily here. I had a student that came every weekend from Turks and Caicos.
The couple over there,
They used to come from Jacksonville. I had another successful development student that came from Tampa every weekend. So commuting's not an issue if you're focused. Anything. Okay, Kawasi, you're on.
REITs, or Real Estate Investment Trusts, were created by Congress in 1960 to give all Americans the opportunity to benefit from investing in income-producing real estate. REITs allow anyone to own or finance properties. In the same way shareholders benefit by owning stocks in other corporations, the stockholders of a REIT own a share of the income produced through real estate investment without actually having to go out and buy or finance property. This video provides some insight into what REITs are and how they work. The REIT industry has a diverse profile, which offers many benefits. REITs often are classified in one of two categories: equity REITs or mortgage REITs. Equity REITs own a wide range of property types, including offices, shopping centers, hotels, apartments, and much more. Equity REITs derive most of their revenue from rent on those properties. Mortgage REITs may finance both residential and commercial properties. Mortgage REITs get most of their revenue from interest earned on their investments in mortgages or mortgage-backed securities. In addition, REITs may be publicly registered with the SEC and have their shares listed and traded on major stock exchanges. Or they may be publicly registered with the SEC, but not have their shares listed or traded on major stock exchanges. Or they may be private companies, not registered with the SEC and not listed or traded on a stock exchange. Regardless of the type, REITs operate under a specific set of rules established by Congress. A REIT is an entity that is modeled after mutual funds, is treated by the Internal Revenue Code as a corporation, must be widely held by shareholders, must primarily own or finance real estate, and must own its real estate with a long-term investment horizon. The IRS implements the REIT rules and oversees what qualifies as a REIT. The Internal Revenue Code requires a REIT to adhere to the following essential rules. At least 75% of the corporation's income must be earned from real estate as rent, real estate interest, or from the sales of real estate assets. At least 75% of the corporation's assets must be real estate assets. At least 95% of income must be passive. REITs are required to distribute at least 90% of taxable income annually to shareholders as taxable dividends. In other words, a REIT cannot retain its earnings. Like a mutual fund, a REIT receives a dividends paid deduction, so no tax is paid at the entity level if 100% of income is distributed. REIT shareholders pay taxes on dividends at ordinary rates versus the lower qualified rate. The top ordinary rate is now 39.6%. Over time, REITs and the rules and regulations that govern them have evolved to meet the changing needs of the real estate industry and the broader economy. But throughout that process, REITs have remained true to the mission laid out by Congress in 1960, to make the benefits of income-producing real estate accessible to anyone and everyone. And that's still how they work today.
Well, that lady writes as well as I do, doesn't she?
Yeah.
Alright, so Professor didn't really want to focus so much on what REITs are because it's covered in another class, but I thought this video was beneficial, so I showed this.
Are you going to keep using this?
No. Gotta close it. Yes, yes. I
Oh,
can.
okay.
Four
Sorry.
points gonna come up
Sorry.
next.
Hold on.
Alright, so I'm going to cover this focus really matter, diversified versus specialized. And that what it is that some REITs are diversified and some REITs are specialized, meaning the asset class. So we have some REITs that invest in different asset classes, and some REITs that invest in strictly one asset class. So we already covered what REITs are in the short video. It's an entity or taxable corporation by the IRS. It's managed by a board of directors or trustees. It must have a minimum of 100 shareholders, no more than 50% or fewer of the shares by 5 or fewer individuals. So by diversification, currently there are only 10% of REITs in the US that are diversified REITs. The other 90% of REITs are specialized REITs. Now that sounds kind of, you would think it would be the opposite way around, since diversification, as I would show later, it really matters and it's less risk when you diversify, based on what the research shows. But for some reason in the US, 90% of REITs are specialized. The article that I was provided was by a professor from the Atlantic School of Institute, Ziobrowski. He did a study on REITs performance, and his study went from 1997 to 2006 on REITs that are specialized and REITs that are diversified. And to conduct his study, he did a capital asset pricing model. We covered that in a class about 2 weeks ago. Not to belabor the whole thing, but the CAPM gives us a good idea as to what risk the asset class has. So he was able to use the capital asset pricing model, as well as there's another model that he used called the FAMA French model. That was later modified to add another factor to it that is called the K-Hertz model, and the modification of the FAMA model just added a momentum feature to it. So it was just an extension of the FAMA model, but it added a factor to it that analyzed the monthly and sort of like monitor the monthly movement of the stock. So based on all his analysis, okay, so the CAMP model, we know what that is, the rate of return plus the beta. We covered the beta last two classes. The data that we use, right, so the CAMP is how you calculate that. You use the rate of return plus the beta multiplied by the market expected rate of return and minus the rate of return. Okay, so the conclusion of the Ziobrowski study is that he found that diversified REITs offer significantly higher market return risk profile than the specialized REITs. The CAMP came back with this. The specialized REITs, that the specialized REITs offered 10% higher risk profile than the diversified REITs. So if you had to choose between the specialized or diversified, what the study basically says is that they offer the same return but with less risk for the diversified REITs. So specialized REITs, we pay a price for the lack of diversification in terms of hires for the same. Any questions?
So you mentioned on the previous slides that there is only 10% diversified and 90 that is not.
Correct, yes.
So if that's the case, and there are, I mean, not just for this presentation, but even the one I did, and it's proven that you should diversify. What is
Why?
still, I mean, why still there is
I
not?
know we have an expert up there, why doesn't he tackle that one? Let me see what he has to say.
I mean, why still they have that very, very low percentage of, diversified portfolios?
Because,
I mean, it's the same return, right? It's
Right.
just less risk.
Well, based on my research, is because there's a misconception that a manager who specializes and focus on a particular asset class, that he's able better to perform than a manager who focuses on like different asset classes. But then there's a counter argument to that says that in a diversified portfolio, it doesn't mean that you can't have different asset managers manage each class of property. So, but it depends on what cost goes into that as well. So there's an additional cost to hiring additional managers to manage each different class of property. Because one manager can't manage all the different classes of property. So it's just sexier. People just like a certain class of assets, and they think that because the manager focuses on a particular asset that he specializes in that asset. Professor may have a different reason, but I'm the expert here today.
No, I'll pipe in on that, Danilo. Did you want to add something to that?
No, I just wanted to kind of like piggyback on that, just a question. So diversified assets have a higher cost?
No,
No?
no, diversified assets have
Lower, according to your.
No, they have a lower risk.
a lower risk
A lower
tolerance,
risk,
correct.
yeah, but the fact that
You have to manage.
they have to use more managers or more labor in order to still manage all the different assets.
Right.
Does that have a higher cost?
Yes and no, because there are other costs in specialized REITs as well that would offset it as well. Like, with a diversified fund, I don't know if, when the capital is there, they have to use it. So, with a diversified REIT, the capital is always at work. Whereas a specialized REIT, the asset, that market may be down, like residential may be down, so they're not throwing a lot of money at it. So there's a lot of capital.
Well, I would answer that differently. I'll pipe in here now. When you're an asset manager, you never have funds sitting around because there's a cost to funds.
Right.
So you always deploy the capital that you have. I think your question probably is best answered by saying cost is irrelevant when we're looking at returns, because returns already have they're sort of net of whatever revenues and expenses there are. So if Kawasi's talking to you about returns, that already has costs associated with that. So there may be a higher cost, but that's going to be embedded or netted in the return somehow already. So now I'm not saying there's a higher cost or not, but I'm just saying
It doesn't matter.
we're looking at something beyond cost already, that already has that accounted for. Do we have any other? Okay.
Do we have any idea as to the scale, like 90 versus 10? Like what type of numbers are we talking about here? I know there's a lot of REITs probably registered in the United States, but I mean, I don't know that the sample size is going to make a difference, right? But I mean, if it's 10% of numbers you're looking at versus 90, like you've got a lot more data here to come up with a conclusion than with a little 10%. I don't know if that has anything to do with it.
That's one of my first points here, which is
Okay. I found that the volume, I guess you're talking about the market capitalization of each asset class?
Yeah, I just mean like how many registered REITs are there? Do you know?
registered, no, publicly traded, there are 230, something like that.
And private ones are like 1,000.
Yeah, but I don't know how much information there are on private, non-listed,
No, I just
either
meant
private or
specialized.
non-listed REITs.
Specialized versus, diversified, so there's 230, so now you're talking about 23 that are diversified, so how much data, you know, you're comparing 200 versus 23?
Well, I mean, I'll jump in further, but just to answer your question, theoretically, Ben, it theoretically should not matter if you've got a significantly sizable strata, and let's assume 10% is significantly sizable, that we should be able to get a representative, you know, sample out of that population to project something. But maybe we don't, okay? That's a valid question that I have. That's my first question here, okay? But any other questions? No, come up. Okay, very good. Okay, but don't take that down, because there's a couple of things. So, I mean, listen, let's just, while you're here, listen, you can't have 3 computers in front of you and try to make a presentation, because you get lost. Because then you're more worried about what your things are, and you're reading, and I'm going to read something that he wrote, which I thought was very simple, and it says, the research found no evidence of superior evidence associated with REITs specializing in a single asset class. On the contrary, diversified REITs somewhat outperformed specialized REITs, although not by a statistically significant margin. Also, consistent with this theory, the research found that specialized REITs have higher market risk. And that really was, I mean, that's your whole presentation, but if you would have remembered that, you didn't have to read it, okay? So basically, the research this guy did in this short time frame basically said, look, the returns aren't really different, but don't turn it off. Oh, okay, I want this stuff. Okay. A couple of things. Yeah, so there's a whole bunch of rules. There's a whole bunch of rules to being a REIT, and maintaining REIT compliance is a bitch. And once you're a REIT, you got to do whatever it takes to maintain that REIT election. So it's hypothetically a taxable entity, but it is not a taxable entity. A REIT is a pass-through entity. Okay, so it's like a partnership in that, you know, it doesn't pay taxes. Okay, if you meet all these rules. Okay, and so it has to have a diverse shareholder base. It essentially has to have the preponderance of its assets and its income related to passive income. Okay.
So REITs, LLCs, or what?
They tend to be partnerships. They tend to, well, so the corporate structure, the holding company is likely some sort of Maryland or Delaware, theoretically I'll call it corporation, but the operating entities, and I don't want to, are either up REITs or down REITs, and they're just, you know, different. I want to talk to your point and to Ben's point, since he's about to fall asleep. I question whether 10% of the REITs are actually specialized. I'm sorry, diversified, which is radically different. So let's kind of walk back to something that's really important in the context of private equity. Almost all private equity funds are highly diversified. And they tend to be diversified geographically, and they tend to be diversified asset class-wise. And when REIT started, so REIT started in 1960 as a way for Congress to provide individuals with access to passive income opportunities and provide a tax incentive to do it. So the entity doesn't pay tax, so there's no double taxation on the income. In exchange for that, the dividend is taxed at ordinary tax rate. So it could go up to the 40% marginal tax rate that we have, 39 whatever, okay? So REITs had a heyday up until the early 70s, and there were a bunch of blow-ups. And especially there were 2 or 3 large mortgage REITs based here in South Florida, and it was everything else in South Florida. They blew up, and it was a big mess, and REITs fell out of favor until the early 90s. They sort of came back. But when REITs started, they were also, just like private equity, highly diversified. And that's changed. And I think what's happened is it is in favor for managers to say, hey, we bring special knowledge about this asset class, and so we're just gonna focus on that. So what do you do about that? There's no problem with that. Because if you want a diversified public equity real estate portfolio, what can you do? What can you do? What can you do?
Diversified
Class.
public equity portfolios, you said?
If I want a diversified public equity real estate portfolio, what do I do?
There are buying different asset classes.
Well, not different asset classes. I buy the stocks of different specialized. I buy the stock of
Specialized REITs.
different specialized REITs. So if I want exposure to retail, I could buy Simon, or I could buy Tubman, or I could buy General Growth, or I could buy National Retail Properties. If I want exposure to office, I could buy Boston Properties. I could buy MSRED. I could buy Cousins. If I want exposure to multifamily, I could buy, you know,
But there are a lot of fees involved in that.
well, it's $8.95 a share, or a trade.
Yeah, well, versus.
So what I'm saying is
That's never been up, you're right.
you could pay a management business, to Danilo's question, to have a bunch of different specialized managers, or you can construct your own diversified. Now, you could also buy an REIT index fund with low cost and just go along for the ride of the whole sector also, okay? I don't know the weightings of what this 90-10 is, but I also asked a question. I just don't believe there's really that many diversified REITs anymore. So my question would be, and this is kind of dated also, although that's a good time frame to follow, okay? Because it doesn't have all the distortion of 2007, 2008. But I would guess there are fewer than that now. But, you know, I'd ask the same question, is how telling that really is of, you know, of everything, okay? The other problem that you have, and I don't want to get into this, is public equity behaves a lot more like stocks than it does like real estate. And that just has to do with, during this time frame, REITs started being included in the major indices. So if this stock got added to the Wilshire 2000 or the S&P 500, then all the fund managers had to buy it. And so if I get to it in this class, I'll show you. That won't be today, obviously. Okay. So that was one thing. Yeah, so just the whole thing, when we talk about CAPM, ultimately what this guy is looking at is, so, yeah, what I wanted to just clarify to be clear, so what CAPM says is that expected return equals your risk-free plus beta times the excess return of the market over risk-free. Okay, this is the actual CAPM model, okay? Capital asset pricing model, okay? And ultimately, and again, I don't have time to show you this today, what the test is trying to do is using this sort of expected return prognosticator, you know, to see what the expected returns or what the actual returns of diversified versus specialized REITs, okay? And let me see what else I wanted to.
Use that CAPM thing with finance or investments.
Yeah, so that's what I wanted.
CapEx, capital expenditure.
And so basically the conclusion in all of this was, the conclusion in this particular article was that this author found in this period with the study that they did that diversification trumps specialization, not in excess returns, but in minimized risk, okay? And I'll leave it with that. Now, the only thing, and again, I'll say, because some of you still have things to do, and I would just say, I thought you put together a very nice report on the article. I would have liked for that data to have been extended and found other research on like or similar, you know, comparisons to see if we could triangulate to an answer. Because again, one of the underpinnings of modern portfolio theory is that diversification should enhance return and lower risk. This didn't seem to cover both angles. It seemed to address the risk one but it didn't really give you, any sort of answer on return, okay? But that was it, okay? Thank you. Because I can't wait to leave.
You get 2 applause. Man, you're good.
Okay, so with that, class session number 6 has concluded. It's been a pleasure, been an honor. Thank you for coming here on a Thanksgiving weekend. Okay, we can turn it off. Dr. Forgy, we found it, yes?